You ever look at a stock price that's jumping all over the place and wonder, what is actually going on with this company? Well, the real story, the wins, the losses, the big strategic bets, it's not in the stock chart. It's written in its financial statements. And today, we're going to decode a crucial chapter of that story, the income statement.
So, where do the pros, the serious investors, look to get the real story? They read the financials. And the income statement? That's chapter 1. It sets the scene for everything else. Let's dive in.
Okay, so the income statement, it's one of the big 3 financial reports. The easiest way to think about it is like a company's report card for a specific period, say a quarter or a whole year. It shows you exactly how much money came in the door, how much went right back out, and what was left at the end. It's really the ultimate scorecard of performance.
So here's our game plan. We're going to walk through an income statement, just like a Wall Street analyst would. We'll start at the top with revenue, then figure out the margins, dig into the costs, land on the all-important bottom line, and then, this is the cool part, use all of that to see how you can peek into the future.
Every story has a beginning, right? In finance, that beginning is always revenue. You'll hear people call it the top line because, well, it's literally the first line on the statement. It's the total cash generated from sales, but it tells us a lot more than just that.
But here's where it gets really interesting. Companies don't just give you one giant sales number. They break it down. We're going to use Apple as our case study today, and you can see they split their sales into 2 big buckets. Products, that's the physical stuff, your iPhone, your Mac, and services, which is all the digital stuff like the App Store and your iCloud subscription.
So why bother splitting it up? I mean, who cares, right? Well, you should care, as an investor, because this little detail is a massive clue about the company's entire strategy. For years, Apple's leadership has been telling everyone they are laser-focused on growing that services business. By showing us these numbers separately, they're basically showing us their report card on that specific goal.
And boom, here's the proof in the pudding. This chart tells the story visually. Just look at the growth rate for services. It's absolutely crushing the growth from products. This isn't just a number. It's confirmation that their big strategic shift is paying off and fundamentally changing what Apple is as a business.
All right, so we've seen all the money flowing in, but what about the costs to actually make the stuff they sell? That brings us to our next stop down the income statement, calculating the gross margin. Now, before we get to the margin itself, we have to understand this term, cost of sales. You might also hear it called cost of goods sold. It's pretty simple, really. These are the direct, hands-on costs of making a product. For an iPhone, that's the screen, the processor chip, the battery, and the wages for the people who put it all together.
And now for the fun part, the analyst's toolkit. To get the gross margin, you start with your total sales, that top line number. Then you subtract the cost of sales we just talked about. What's left is your gross profit. Finally, you divide that gross profit by the total sales number. That percentage you get, that's the gross margin, and it's a super powerful way to see how profitable a company's core business really is.
So what does this number actually tell you? In a word, power. Pricing power. A higher gross margin is always better. Let's say it costs Apple $500 to make an iPhone. If they sell it for $1,000 instead of $750, their gross margin skyrockets from about 33% to 50%. That's the financial muscle of a powerful brand.
And this right here is the big aha moment. This is what explains Apple's entire services strategy. The gross margin on their services is nearly double the margin on their physical products. Think about it. It costs them way, way less to sell one more iCloud subscription than it does to build and sell one more iPhone. Now you can really see why that shift is so unbelievably important to their profits.
But here's the thing, you can't just look at this number for 1 year and call it a day. What you're really looking for is the trend. And for Apple, as their high-margin services business has gotten bigger and bigger, their overall gross margin has been climbing steadily. This is exactly the kind of beautiful story you want to find as an investor.
Okay, next up, operating expenses. We've handled the cost of making the products, but what about all the other costs of just, running a massive global company? We're talking marketing, research, all that stuff.
Usually, these expenses get sorted into 2 main buckets. First, you've got research and development, or R&D. This is the money they spend trying to invent the future. Think of all the cash Apple is pouring into its secretive car project. Then you have SG&A, which stands for Selling, General, and Administrative. This is the day-to-day cost of doing business. Ads, office rent, executive salaries, all that jazz.
And here's another little trick that analysts use to spot a really well-run company.
You want to see its sales growing faster than its operating expenses. When that happens, it's a sign that the company is getting more efficient as it gets bigger. It's achieving what they call scale.
And if we look at Apple's numbers, you can see this exact principle in action. Back in 2019, their SG&A costs were 7% of their total sales. Fast forward to 2021, and that number dropped to 6%. That downward trend is a fantastic sign of increasing efficiency.
All right, we're getting close. We've tallied up the money coming in, we've subtracted the cost of making the products, and we've subtracted the cost of keeping the lights on. It's time to put it all together and get to the famous bottom line.
The math from here is super simple. You take your revenue, subtract the cost of sales, subtract your operating expenses, and what you're left with is called operating profit. This number tells you exactly how much money the company made from its main line of business before things like taxes get involved.
And you know, just like we did with the gross margin, we can turn this into a percentage to see how things are trending. We call that the operating margin. And what do we see with Apple? Another beautiful upward trend, growing from 24% in 2019 to nearly 30% in 2021. This is where you see everything: the services growth, the pricing power, the efficiency, all coming together and paying off big time.
Okay, so after the government takes its cut in taxes, we finally arrive at the grand finale: net income. This is it. This is the bottom line everyone talks about. It's the final, official profit, the grand total, at the end of the story for that year.
Look, understanding what happened in the past is great. It's crucial. But the real money in investing is made by figuring out what's going to happen next. And the real power of this whole analysis is using it to forecast the future.
This is where the real work of an investor begins. They build these things called financial models, like the super simplified one you see here. They take everything we just learned and start making educated guesses. What if services keeps growing at 20% a year? What if their product margins get a little better? What if they keep getting more efficient? By changing these little assumptions, you can project what future profits might look like and decide if the stock is a good buy today.
So we've gone on this whole journey, right? All the way from that first dollar of revenue at the top of the page, down through all the costs and expenses, to that final profit number at the very bottom. The income statement isn't just a boring accounting document, it's a story about strategy, execution, and performance. So I'll leave you with this question. Now that you have the tools to read a company's past, how would you predict its future?